flow. Now the repayment of the principal on that operating cash flow becomes a financing cash flow. And the interest component, this 5835, is actually the difference between the 100 and the interest, right? That's the repayment of the principal. So the 49,165 is the interest. Depending on how you currently classify the interest cash flow, whether it's an operating activity or a financing activity, it will remain the same. But what I'm trying to point out here, and this is the underlying philosophy of IFRS 16, is that leasing is now seen as a financing activity. Let's go on. The impact on the balance sheet. Now, without the numbers, let me just go and summarize what's going to happen to you. Under IFRS 16, you're going to have more assets on the balance sheet. So airlines will now have aircraft, thank goodness. But they will also have more liabilities. And the asset and liability will go down to zero, but the asset goes down quicker than the liability. So you'll have a net equity position. Your income statement won't be the same anymore. Your income statement changes as well. You will have a front loading of an expense rather than a straight line expense. And people don't like this. Why? Business doesn't work like this. Normally people start building up their business. What I'm trying to tell you here, matching is gone. If you thought matching was gone, it's dead now. Do you understand that? It's completely gone as a concept. It no longer exists in its form. Your financial ratios, what's going to happen to your ratios? You are going to have an increase in EBITDA. Earnings before interest, tax, depreciation, and amortization will go up. Yes, it will. It will go up because your operating lease expense used to go through earnings. Now you don't have that. You've got now interest and amortization as expenses. Your balance sheet assets will go up. Lovely, that sounds good. Airlines will have more assets. Everybody will have more assets. Banks will have more assets. Your gearing will go up. Your debt to equity ratio will change. What will go down? Things go up, things go down. Earnings per share will reduce in the initial years because lease expense gives you a heavier burden in the start. So you'll have a hit on EPS initially. Your net assets, you'll be in a net liability position for the duration of the lease. Your interest cover and your asset turnover will also change. These are big changes. Let me talk about things. Let's go further. In my practice so far, I have been looking at doing impact assessments for many clients. We've been working through this. Can I tell you what are the biggest challenges? Here's the biggest challenges. Finding the lease agreements. Today, companies have hundreds of lease agreements. The big ones we know about. And the ones that you're accounting for finance lease, you have the documentation. But all those 100 of ATMs, if you are a bank, you don't have those lease agreements. They sit, I'll tell you where they are. They're sitting in a filing cabinet. You are putting through a MIS entry, an automatic entry to book the lease expense every year. You don't know the discount rate. You're not sure of the term. What I found in practice is we can't find enough, or we can't find all the leases. What if you've got a subsidiary in Egypt that has 20 premises on lease? Where are all those lease agreements? They're sitting in a cabinet, no. But there's no way we know how to do the accounting for it as a liability. You understand these things. So this is genuine. We've seen this problem is to extract the data, to get the data, to find your leases, to move them from the filing cabinet onto at least an Excel spreadsheet. The second problem we're finding, or the second reality we're experiencing, is look, when clients see the impact of IFRS 16, you know what they want to do? Their whole idea is, let me reduce the liability. Now, I'll tell you all the arguments. I think I've heard most of them, right? My clients will come to me and say, wait a minute, Yusuf, don't worry. This is a one-year lease. You know why they want to say it's a one-year lease? Because they don't want the liability. They will argue it's a one-year lease, but it's renewable 20 times. IS 17 defines the lease term as the non-cancelable period of the lease, including renewal options, if it's reasonably certain at inception that you will exercise. IFRS 16 says the same thing. You can't tell me it's a one-year lease. If you have gone and put in fittings and fixtures that last 10 years, you cannot argue to me that it's a one-year lease. If you're telling me it's a one-year lease, depreciate your leasehold improvements over 1 year, sir. You understand that? So people have been trying to reduce the lease payments by telling me the liability by telling me the lease term is 1 year. Oh, it's a 1 year cancelable. And my response to that is, really? Do you want me to believe that? I was an auditor, you know. You understand that? The second thing, the second way that clients are trying to reduce the liability is they want to go with a high discount rate. The higher the discount rate, the lower your liability. Stupid idea. It's a stupid idea because, yes, you get a lower liability, but guess what? Heavy interest expense. Bad idea. Then I'll tell you some really smart plan that somebody came up with. So this company had a 5-year agreement to provide staff accommodation for 120,000 dirhams. 100,000 dirhams was the leasing component. 20,000 dirhams was the servers, breakfast, food component that they had to pay per year. Right? So they went to the landlord and said, look here, Mr. Landlord, if I apply IFRS 16, this 100 will be booked as a liability. The service component, there's no, IFRS 15 doesn't want me to book it as a liability. So Mr. Landlord, I'll still pay you 120. Make the lease component 1 dirham and make the service component 119,999. You know why? Then I book a liability of 5 dirhams. IFRS 16 doesn't allow that. It actually forces you to do a proportionate reallocation even between the lease arrangement and the service arrangement. You understand that trick? But the trick that I found that does work, and I don't call it a trick, is to challenge the definition of the lease. If I challenge the definition of a lease, I sometimes can get to situations where something you did classify as a lease isn't a lease under IFRS 16. Okay, so that's the issue. So what I'm saying here is before, historically, you did not have to make so much on your operating leases, lease term, discount rate, split between lease and non-lease components were never judgments that you had to make. Now there are judgments that you have to make. Your balance sheet's going to be volatile. Volatile means even if you have a simple business operation, because of the lease changes, your balance sheet is going to be volatile. Changes in metrics, we spoke about the ratios that will change. It's going to affect your dividends, it's going to affect share-based payments, it's going to be affecting bonuses. Communication with shareholders will require consideration, and I'll tell you why. We've spoken about the IFRS 16 impacts to clients, and guess what has happened? These clients are extremely concerned. In fact, when we've brought it to the audit committees, they are worried about meeting targets, meeting budgets, meeting key performance indicators. Some impacts we haven't yet quantified. Transition options. How are you going to transition to the standard? What happens on 1st January 2019? You have to restate, right, prior years. How far back do you go? Do you go and decide the discount rate for a lease you entered into in 2002? The discount rate in 2008 is very different to a discount rate in 2014. How do you apply this? What was the lease term when you entered into this? How are you going to move on to the standard? All the operating leases that you have on 1st January 2019 have to become finance leases. How are you going to do that transition? Do you want to restate comparatives? Should you restate comparatives? Do you want to go relook at the lease definition for everything? These are your transitional considerations that you have to make. Changes in contract terms in businesses, you may get people coming to you. If you're the landlord, people may approach you. Or you may approach your landlord saying, hey, let's change this. Maybe people will decide to buy assets more rather than lease them. And finally, new systems and processes are required. So look, I've done industry impacts in the UAE so far. I've looked at where in the UAE there is an impact. If I have to do globally an impact, guess what? Every company that has leases will be impacted. But where I've seen specific impact of the new standard is airlines. Obvious reasons. Airlines don't have aircraft on the balance sheet. Banks, that's tricky. Banks would say, hey, wait a minute, I don't have an issue. You do. All the premises where you're leasing ATMs are not on your balance sheet. Retailers. So if you've got a Starbucks franchise and you've got 50 Starbucks stores in different malls, guess what? You have to bring these on balance sheet together with the obligation. Schools. Schools have long-term leases. We've seen a lot of issues with them. Power and utility companies. Power and utility companies, I'm struggling with the definition here. I think they won't be leases. Logistic companies, some of the arrangements that they have entered into, we've managed to get them out of the leasing standard. What I've included here, just for information, not too much of a discussion, is the Emirates Airlines financial statements. And I don't think you can see this too clearly. So what I'm going to tell you here, I'm just going to go through this little table here. This is the actual Emirates Airlines fleet information. Emirates Airlines has, at 31st March 2016, they have 251 aircraft, of which 156 are not on the balance sheet. This is what they're telling you. They're under an operating lease. 90 are on a finance lease. Guess how many aircraft they actually own? 5. They actually own 5 aircraft. But you know what's scary? They are placing an order for another 250 aircraft. So this airline, I don't know, it's going to go really big. All right, and there are additional options. When you're talking of additional options, these are highly structured transactions for aircraft with different parties to get tax benefits. There's another 70 that potentially could come in there. So look, the reality is, this is a relevant standard. When Emirates Airlines presents this, they genuinely know that they are going to expect a change. If you could read the other pages, they are actually including the lease commitments and the lease payments as a financing activity already, or they want the user of the financial statements to understand that leasing is financing going forward. All right. Let me start quickly with the definition, and then we'll do the break for prayer. All right? We started a little late, but let me start off on the definition. So far, what I've done is given you an overview of the standard. What I'm now going to do is, as I said, the big discussion or the big thing you need to take away is the lease definition. If you know the lease definition, or you're in the standard, if you meet the definition. The lease definition changes. Under the current standard, there is a lease classification test which says if it's a finance lease, it's on balance sheet. If it's an operating lease, it's off. There's no issue anymore of finance lease or operating lease. The issue now is if it's a lease, it's on balance sheet for a lessee. And if it's not a lease, then it must be a service agreement, which is off balance sheet. You agree? Okay. Now, that is why, for me, the definition is critical. You need to meet the definition. And I'm going to show you with examples how the definition gets met. In order for there to be a lease, you need an identified asset. You cannot have a lease when there isn't an identified asset. So you need an identified asset. The lessee needs to obtain all the benefits. The lessee needs to direct the use. If you say no to any one of those, you fail the definition of a lease. And because these are and requirements, means it's not all. You've got to meet all three. What we're finding in practice is some of the leases do not qualify for the definition. What do we mean when we say you have an identified asset? You see, an identified asset is something that is there. You can clearly identify a lease. For example, if you enter into an arrangement for a lease of a photocopy machine, if you can lease any photocopy machine, it isn't a lease. But if you are leasing a specific machine from Xerox or whoever, then you have a lease. It has to be a specific asset. If you can have access to any asset or any car, or any operation, then it's not a lease. Let me give you an example, a few examples. Let's say there's a kiosk space